Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video interview with Jim Fink, Chief Investment Strategist of Velocity Trader. It's our premium trading service, and today you're going to learn some secrets from Jim Fink about how to make exponential gains in a short amount of time. Jim, thanks for joining us.
Thanks for having me, John.
My pleasure. Today, I want to talk about velocity. You know, Jim, I've often overheard you say, don't trade stocks, trade velocity. What do you mean by that?
Well, John, velocity refers to the speed of generating profits. Stocks can double or triple over time, but it usually takes years. Now, there is a way to generate such 100% and 200% returns much more quickly, in days rather than years, and that involves the use of options as a substitute for stock. Now, in chemistry terms, call and put options are like the atoms that make up a stock molecule. When you buy a stock, you are buying exposure to the full range of a stock's price movement, up and down, for an unlimited period of time. Now, stock is a very blunt and expensive investment instrument that's sort of like being forced to buy a 300-channel cable TV package when all you really want to do is watch Nickelodeon and the Food Network. Now, options allow you to limit your capital at risk to only those portions of a stock's price movement that you want, and for only the period of time that you think necessary. This provides the trader with the ability to benefit from a stock's price movement, but at a much lower cost than buying stock. But there is yet another step you can take with options to reduce your risk even further. It is a secret that option professionals have been using for decades, but which have only recently entered the mainstream. This extremely powerful tool is known as spreading. Now remember, since each option is a derivative contract, it can be sold without owning it first. By selling an option at the same time that you buy an option, you can actually help finance the cost of the purchased option and lower your cost basis further. Remember, a lower cost basis while maintaining the same profit potential increases your rate of return. So because the outperformance of spreads is limited to cases where the stock rises only modestly, option traders often characterize spreads as possessing regional leverage. Within the region of modest price appreciation, the option spread can't be beat. But individual calls will outperform in cases where the stock makes a huge price move. But isn't it better to bet on modest price moves than a huge price move? You betcha. Another advantage of selling a call to reduce cost is that you can often totally eliminate the time value surcharge on the long-term call option that you are long. In other words, you get all of the upside of stock ownership up to the stock price of the sold call at a fraction of the cost of stock and without suffering any time value decay, which is the best of both worlds. In other words, John, options provide tremendous leverage that speeds up profit generation, and faster profits equal velocity. Now imagine you looked at Broadcom stock, which is ticker symbol AVGO. Let's say you looked at it on November 19th, 2020, which is right around when I recommended a trade in Broadcom. You might have noticed at the time that Broadcom, which is a semiconductor giant, had excellent third quarter financials. It beat analyst estimates in both revenue and earnings. So you might have figured that you could buy the stock. And by the end of the year, if you had bought the stock, you would have earned a solid 15% gain. That's nearly twice the average annual return for most investors in a little over a month and a half. Now on the surface, that sounds pretty impressive. But when you think about it, if you'd invested just $5,000 on that Broadcom stock, you would have only made about a $750 profit. But if you had traded Broadcom's velocity using option spreads, well then, boom, you could have doubled your money in only 8 days. And that means instead of sitting on $5,750, you'd be sitting on $10,000 in just over a week. That is the type of option leverage I'm talking about that has the power to generate huge profits in a short amount of time, which is what I mean by velocity.
Well, Jim, you make a pretty compelling case. You've devised 4 velocity filters that allow you to anticipate rapid accelerations in stock price movements before they happen. How do these filters work exactly?
Well, John, I'm glad you brought up velocity filters because they are a critical part of my trading system. Having a system based on probabilities and risk reward calculations is important. After all, option leverage can work both ways, so that trading options can lose money just as fast as it can make money if you don't have a time-tested system that puts the odds in your favor. It's similar to playing blackjack in the casino where you count cards and you know when the odds favor you winning a hand against the dealer versus losing the hand. You bet big when the card deck has few face cards remaining and the odds of busting above 21 are low, and you bet much smaller, or not at all, if the card deck has a lot of face cards remaining and the odds of busting are high. The same thing is true with my option trading. Probabilities are everything in a successful trading system. And my velocity filters put the probability of success in my favor so that the odds of profit are much, much higher than the 50-50 odds of any random option trade. So to get to specifics, the 4 filters in my velocity formula can be expressed as follows. V, which is velocity, equals C plus M plus P plus H. Now what does C, M, P, and H stand for? Well, I'll get to that now, one at a time. Now, this formula allows me to discover stocks whose velocity is about to rapidly accelerate. And that means there's a ton of money to be made on them. You see, this simple formula uses 4 variables to help narrow down the entire market to specific trades with the power and potential to take off. Think of it like a funnel. Stock tickers pour into the top, and these 4 velocity filters screen them for potential profits. Now, the first component of my velocity formula is the letter C, and C stands for crossover, specifically the crossover of different period moving averages. The technical indicator that I use is officially known as MACD, which stands for Moving Average Convergence Divergence. This deals with an 8-period moving average and a 17-period moving average. The 8-period moving average is the short-term average, and the 17-period moving average is the longer-term or slower line. So the first is the fast line, the second is the slow line, and when the fast line crosses above the slow line, meaning the 8-period moving average crosses above the 17-period moving average, that's a strong buy signal, because it proves that momentum, positive momentum, is building in the stock. Or to put it in another way, the short-term performance of the stock is starting to outperform the longer-term trend of the stock. What we're talking about here is a significant trend change for the better, which increases the odds that the share price is about to rise dramatically. Number 2, the second component of my velocity formula is the letter M, which stands for a stock's momentum. Momentum, as you might recall, is a fundamental law of physics. It was first discovered by Isaac Newton way back in the 17th century. You've probably even heard it described using this phrase: an object in motion stays in motion unless acted upon by an outside force. Incredibly, this universal law doesn't just apply for bodies traveling through space. It also affects stocks. And that's exciting, because the ability to calculate a stock's momentum allows me to predict whether the direction it's moving in is likely to continue or if it's in danger of stopping and reversing. One of my favorite buy signals, which I call the double barrel pattern, is a buy signal based on 2 technical indicators. The first barrel is the moving average convergence divergence, or MACD, which I have already discussed. So a positive MACD is the first barrel of the buy signal. The second barrel of the double barrel buy signal is an indicator called the stochastic oscillator. It moves back and forth between the numbers 20 and 80. It's measuring the degree to which a stock has been near the high price of its 14-period range. If you get up to 80, that means it's trading near 80% of its high price for the time period, which is usually a bad sign and means that a stock has exhausted itself. That's why I like to wait for 20, which is when a stock has retraced down to 20% or less of its high price for that time period. The stochastic oscillator is how I prove that there's enough room in the price for a big run. So to conclude, the double barrel buy signal is based on a stock's momentum and is extremely powerful because it tells you not only when there's a significant trend change, but also that there's enough room in the price to follow through on that trend change. Now, the third component of my velocity formula is the letter P, which stands for pain. But don't worry, it's not actually painful. Wall Street insiders, also known as the smart money, use all sorts of secrets to stack the deck in their favor. I mean, think about it. If somebody's losing money in these option trades, then someone else is making money on them. And it goes without saying that the winner is usually the smart money, which is why, before I make any trade, I always find the point of maximum pain. Now, if you've never heard of max pain before, that's okay. Most regular investors haven't. And I don't want to take up a lot of your time explaining the ins and outs of it here, but suffice it to say that max pain involves an analysis of option open interest and searches for extreme imbalances between the option bets that regular investors have made on a stock's calls and puts. The important thing to remember right now is that max pain is the price of a stock that will cause the most pain for regular investors. And knowing that fact gives you the kind of edge that casinos across the world enjoy. Because rest assured, the smart money will do whatever it takes to make sure the stock's price ends up where it needs to for them to win. And lastly, the fourth component of my velocity formula is the letter H, which stands for history. Everyone has heard of the old saying that past is prologue. Well, this is true for stocks as well. It's called seasonality. And the reason I love it so much is that it is based on what a stock price has actually done in the past, not based on groundless speculation about the future. Most stock charts have several peaks and valleys during a calendar year, and at first glance, this price volatility may look completely random. But that doesn't mean there isn't a profitable pattern hiding inside it. You just need to know where to look, or in this case, when. You see, when there are certain times in most years when a stock share price almost always goes up, and that could make traders who are able to predict those moves a lot of money in the process. Now, that's the kind of pattern investors can make use of. Think about it like this. If it rained on the 4th of July for 9 out of the past 10 years, you definitely want to make sure you had a few canopies handy for your annual cookout this year. So, if you know when specific stocks tend to rise, you can use that advanced knowledge to create trades that deliver triple-digit percentage gains. Knowing when a stock is about to move is really my secret sauce. And it's what I believe sets my formula apart from the ones most other traders use. So there you have it. I have described all 4 parts of my velocity formula, which gives me a proven method for sifting through the thousands of stocks in the stock market and pinpointing the ones with the potential to double your money or more on a consistent basis in a short amount of time.
Jim, that was a great explanation of the rigorous criteria you use before setting up a trade. Let me ask you though, why does your velocity system work better than the traditional buy and hold approach? I think average investors are asking themselves, why is this better than the conventional investing methods I've used my entire investing life?
That's a great question, John, and my answer is very simple. More money in less time is better than less money and more time, right?
Can't argue with that, no.
I don't mean to be flippant, but that's the bottom line. And as I have explained, investing in stocks is much more expensive than investing in options, especially option spreads, which is what I use exclusively. And the vastly reduced cost basis means that the equal dollar amount of profit potential that is available from using either investment vehicle generates a much higher rate of return in the case of options and requires only a small percentage price move in the underlying stock to achieve it. Options magnify a stock's small percentage price moves into a large percentage price move. It really is that simple. Now, most of the time stocks go nowhere, meaning that their price fluctuations are small and in a very tight range. This means that buy and hold stock investing is often a slow and plodding affair, similar to watching paint dry. But options, in contrast, can work well even when a stock price doesn't fluctuate much, provided that you can time the stock's small price moves in the direction anticipated before the options expire. Timing option trades correctly is the secret sauce that makes sure that the low-cost profit leverage that options always provide actually works out in your favor instead of against you. Now, my four-part velocity formula provides the timing, and the option spread structure provides the profit leverage potential. Now, when we put these two together, my comprehensive velocity trading system is an unbeatable profit machine that leaves buy and holding stock investing in the dust.
Like many of our readers, I like real world examples. Case studies can be very compelling. Give us a successful case study of a specific stock to which you recently applied your velocity trading system.
Sure. Well, earlier in our discussion, I've already mentioned a home run bullish trade in Broadcom from November of last year, which generated a 100% return in 11 days. But let me give you another one that describes in more detail how it satisfied the criteria of my four-part velocity formula. On May 25th of this year, with Las Vegas Sands, symbol LVS, trading at around $57.75, I recommended a bearish 57.58 put spread on Las Vegas Sands. Now, this trade had an 11-day duration and required the stock price to drop below $57 by June 4th. So, as you can tell, it was a very short-term trade, and the timing had to be just right for it to work. All four parts of my velocity formula were aligned in favor of Las Vegas Sands dropping in price over the short term. And these indicators gave me the confidence to recommend the trade. Now, this is exactly what my indicators showed on May 25th when I entered the trade. First, MACD was below zero, and the MACD histogram, which is also known as the crossover, was red, meaning that the short-term moving average was below the long-term moving average. That signaled to sell. Second, my stochastic oscillator indicator was in a severe downtrend below the 30% line. So this was near the bottom of the 2080 range I talked about earlier, meaning that there was a lot of room for the stock to move significantly in one direction. In other words, with both MACD and stochastic oscillator agreeing with each other, we had a double barrel momentum sell signal, since both MACD and stochastic oscillator were negative. Third, the stock price chart was weak and meandering for LVS with no real direction, which is relatively weak compared to the uptrend in the S&P 500. Fourth, there was a massive open interest at the June first week expiration $57 call strike. There were 21,498 contracts of open interest, which should have acted as a downward magnet on the stock price because those option contracts were what the regular investor had bet on. And as I mentioned earlier with Max Payne, option market makers want to make sure that those option holders lose money. And so to make those 57 call holders lose money, they'd have to push the stock price down below 57. And lastly, with this Max Payne that I'm talking about, the calculation of Max Payne was actually $56 a share, meaning at $56 a share closing price at the June 4th expiration date, the most regular investors trading options would lose money. So that would be the max pain price, and that would be great for our put debit spread because our put debit spread would make maximum profit at a stock price of $57 a share or lower. So a max pain of 56 would ensure that maximum profit would be achieved. So what happened? At the June 4th options expiration, LVS, Las Vegas Sands, had dropped all the way down to $56.52. And this meant that the 57.58 put spread that I had recommended expired for its maximum $1 per share value, or $100 per option contract, because each options contract represents 100 shares. Now, since the initial cost to place the trade was only a 45-cent per share debit, the trade returned a whopping 122.2% gain. Now, that's more than a double in 11 days. Keep that in mind.
Wow. That's impressive.
Now, to be perfectly frank, finding trades that satisfy all four of my velocity criteria is rare. And I jump on them whenever I find them, as I did with LVS, because they are so powerfully reliable. But the good news is that I have back-tested the success of trades that only satisfy 2 or 3 of my 4-part criteria, and the track record is still very good. So as long as at least 2 of my 4 velocity criteria are met, I'll often recommend a trade, and they usually result in big profits, even though it's not all 4 of the criteria.
Wow. Well, viva Las Vegas. As the chief investment strategist of Velocity Trader, Jim, how often do you issue new trades?
Well, the beauty of my velocity formula is that it discovers high probability trades on a weekly basis. Consequently, every Tuesday morning, I am able to provide my subscribers with 2 new trade recommendations. And on Fridays of every week, I issue trade adjustments for pre-existing trades that are about to expire but need a little more time to reach their full potential. So when you take into account the new trades on Tuesdays and the adjustment trades on Fridays, you are never alone in this trading business. I help you manage every trade from the cradle of initial order placement to the promised land of profit taking.
Leading investors to the promised land. I like the sound of that. What sort of gains have you regularly generated for your followers?
Well, John, I am a disciplined trader, which means that I don't only require that all of my trade recommendations satisfy the specific velocity criteria in my 4-part formula, which maximizes the directional accuracy of the trades, but I also require that trades only be executed at limit prices that ensure a sizable rate of return if the trade works out as expected. I have price discipline. Specifically, I recommend that my subscribers only enter a trade at a limit price that provides the opportunity to generate an absolute minimum 75% rate of return, and preferably a triple-digit percentage rate of return of 100% or more. For example, if I recommend a 1-point option spread that can generate a maximum $1 per share credit at expiration, I will recommend that subscribers initially place the order for no more than 50 cents per share, which would be a 100% potential rate of return. And they can only adjust higher if necessary to 57 cents per share, which would still offer a 75% rate of return. Now, not all trades work out as expected. No trading system does, of course.
Right, of course.
But even those that require trade adjustments along the way often eventually close out for a profit. And of course, I also often recommend trades that can return more than 100%. The criteria mentioned above are simply minimum requirements. Just recently, in May of this year, for example, my subscribers closed out a trade in FedEx that returned a whopping 205%.
Wow, can't argue with that.
And that included a trade adjustment. So trade adjustments can actually enhance trades beyond the initial trade recommendation. Now, overall, I've easily generated at least 24 triple-digit percentage winners over a 12-month period every year since the service started several years back. And my publisher is confident I can continue this type of performance. which is why he offers subscribers a free extra year if I don't produce that many winners. But between you and me, John, I don't think my publisher has anything to worry about.
Well, speaking for him, I don't think he does either. Jim, that was fascinating, illuminating, and for people who follow your system, it's going to be profitable. Thanks for your time.
Thanks for having me, John.
You bet. As we've just discussed, Jim Fink has developed proprietary stock filters that provide advanced knowledge of when a stock price is about to rapidly accelerate. Based on this secret knowledge, Jim constructs trades that have consistently reaped windfalls for his followers. Want to learn about Jim Fink's next trades? Consult the article that accompanies this video on the Investing Daily website. Well, that's it for now. Thanks for watching. Stay safe and stay invested.